Thursday, September 15th, 2022, Maneco 64, home of alternative economics and contrarian views. So if inflation wasn't bad enough, the hidden tax, today we're going to look at another trick that the UK government has pulled on millions of savers and investors. Yes, you probably didn't hear about that in the mainstream media, especially in the last week or so. And what has the UK government done now? Well, they've basically committed a technical default on a quarter of the national debt, or £500 billion worth of debt. So that's what we're going to look at today. Before I start, just go over some of the stories that are out there that I think are significant. The first one is the talk of Prince Charles, or King Charles III now, not having to pay any inheritance tax. Usually in the UK, if you're left with more than about £365,000, everything above that level, you pay 40% to the state. Not very fair. And it stops families from basically passing on their property, what they've worked for decades, and what they had left after paying a lot of tax already. Yeah, it blocks them from passing it on to their families, and I think it's totally unfair. So let's say if someone dies and leaves a £1 million house to just one person, let's say, that person has to find about £250,000 in cash. And I can tell you that from personal experience, knowing what has happened to other people, the taxman comes after you right away. They don't even barely wait for you to bury your loved ones. And they barely wait for you to be able to sell the property to get the cash. Yes, and they make you take a bridging loan to pay that tax. So yes, it's very unfair. The excuse is that we can't allow the royal family to run out of its wealth. Well, so at the expense of millions of families, we're going to keep one family really wealthy. I mean, people need to wake up. It's a really anachronistic, and it's not a fair system. So that's the first topic there that I wanted to touch upon before we go on to how the UK government and his king's treasury, because it used to be Her Majesty's treasuries, will be robbing savers even more. While the other one is about this possible rail strike in the US. First rail strike, in probably 30 years, and it looks like it might go ahead because Bernie Sanders is not voting for a deal that Congress is trying to get through. So that could disrupt the economy even more, the supply chains. So that's out there. And the other topic I wanted to go over very quickly is the fact that today the Bank of England should have been raising rates, but they delayed it for a week so they can keep inflating as much as possible. Their excuse, of course, is because of the death of Queen Elizabeth II. But here we are, all going on with our lives, and the Bank of England just stops. I think that just goes to show you can't trust these people. Anyway, to the technical default. Well, I spoke a few weeks ago about the UK. Britain's debt time bomb has gone off, part 2. You can listen to that video. I'm going to put it up in the cards. And I spoke about index linked bonds, or gilts. So I won't go over it again, but suffice it to say, as you can see here by this pie chart, at the end of last year, it was 493 billion pounds of the national debt, about 22%. So what's happened now? Well, about 2 weeks ago on September 1st, this came out in the FT, and I've been meaning to talk about this. I just haven't gotten around to it, not because it's not important. So FT says UK government wins pension fund legal challenge over change to RPI. Well, RPI is the retail price index. It's what prices or inflation was measured with up until the late 90s. That's the index they used. And they still publish it. And by the way, yesterday it came out at 12.3%. There's all talk that inflation dropped below 10%. That was the CPI. But the RPI, they don't like the RPI because it's actually a much better measure of rising prices or the consequence of inflation, because it includes council tax rises. It includes real house prices, not the owner equivalent that they're using like the Americans do now. So let's go through this and you'll see how, unfortunately, you might be affected by this. BT, Ford, and Marks and Spencer pension schemes argued the new CPIH measure would leave pensioners worse off. So there you go. And it's a technical default because in 2030, the index-linked gilts are not going to be linked to the RPI anymore. They're going to be linked to this CPIH, which is always a lot lower. So it's going to rip off millions of investors and pensioners. So let's go through this quickly because I think it's important. The UK government has won a high court challenge by 3 major pension funds over the legality of a planned change to the calculation of inflation that they contend could leave millions of pensioners worse off. So you go high court. Yeah, the judges, they always decide on the side of government. So it's a sham system, right? Anyway, let's continue. Trustees of the BT, Ford, and Marks and Spencer's pension scheme had brought a judicial review claim against the government over plans by the UK Statistics Authority to reformulate the retail price index inflation measure from 2030 and replace it with CPIH. Yes, CPIH, I said CPHI earlier. A version of the consumer price index that includes housing costs and is seen as a better measure of inflation. Well, RPI includes house prices. They're trying to make it seem that RPI doesn't include housing costs, but it does. Anyway, let's continue. The pension funds, which together represent nearly 450,000 members and 83 billion pounds in assets, has argued the planned change was unlawful and that it failed to properly take into account the impact on millions of pensioners with defined benefit pensions who would be worse off because their annual increases would switch from RPI to the typically lower CPIH. Yeah, it's not just the holders of these index-linked bonds, but also pensioners who are on a defined benefit pension scheme. However, on Thursday, the High Court ruled in favor of the UK government. Yeah, you rule in favor of the hand that feeds you, right? It's not an impartial court, it seems. Ruled in favor of the UK government and rejected arguments that the government or UK Statistics Authority had overstepped their authority in making the changes. Well, there you go. They can change the rules and they can get the courts to agree with them. But one thing they can't change is the weight of a gold sovereign. Here's the 2022 QE2. I think that will be worth a bit in terms of numismatic. Not that I worship the person on the other side of the coin. and they can't take anything away from a double shilling or a florin from pre-1920, right? That, you get my message. Gold and silver, they can't take that away from you. They can't, like they can in the paper market. So anyway, the ruling is significant because 10.5 million people in the UK have private sector final salary pensions, most of which are currently linked to RPI. The pension fund trustees had argued the longer term impact could be worse for women because statistically they live longer than men. In the judicial review challenge, the pension trustees had claimed that the UK Statistics Authority and the Chancellor failed to take into account the impact of the decision on holders of RPI index-linked gilts and bonds and on retirees entitled to index-linked pensions. The pension funds also claimed that the government failed to consult properly with the public about the decision. However, Mr. Justice David Holgate rejected these arguments, and he said, I quote, "Parliament did not find it necessary to confer or spell out an express power to change the RPI." There you go. You just state it, right? Given the history and nature of the RPI as an index measuring consumer price inflation, it is obviously implicit in the duty to compile and maintain that the index that the UKSA is able to change it, he ruled. Ian Diamond, Chief Executive of the UK Statistics Authority and National Statistician, welcomed the ruling and said the proposed changes can legally and be practically made by the authority in February 2030. And I know it's going to be 8 years from now, but it's going to be impacting a lot of people who are still not retired. It's going to screw people even more. It's going to take more and more out of you, just like the inheritance tax will take more and more out of your heirs. He said, at a time of rising prices, it has never been, this is a really good one, it has never been more important to have accurate and trusted measures of inflation right. We have been clear for a number of years that the retail price index is a very poor measure of inflation. Yeah, right, because it measures it correctly and is always higher than the CPI. At times greatly overestimating and at others underestimating changes in consumer prices. I don't agree with them. It's 90, I would say 95 or 99% of the time it overestimates because it's the right one. Do you really believe prices are only going up by 10%? I don't. I mean, RPI says it's going up by 12.3. That's a little better and it's still low. So this argument is just rubbish, I would say, by Mr. what's his name again? Ian Diamond. The Treasury said, "We welcome today's judgment." Of course they do, and are committed to the publication of accurate economic data. Of course they are. A spokesperson for the pension scheme said that they were disappointed with the ruling. Yeah, because the government is defaulted, technically defaulted. This is what he said, this spokesperson. Many investors, including pension funds, bought index-linked gilts in good faith and now face losses of 90 to 100 billion pounds, said the spokesperson. This decision will leave millions of pensioners in defined benefit schemes with RPI-linked benefits poorer through no fault of their own and facing substantial decreases in their year-on-year income. Women will be particularly impacted since they live longer and retire earlier. So I guess that will help keep financing King Charles III and all his projects. Well, he said this year, as Prince Charles, that we needed to do a military operation to make private companies spend trillions in changing the way they operate for the environment. Well, and the trillions, of course, are going to come from us, the taxpayer. So that will help, I guess, King Charles III with his schemes. While, of course, he doesn't have to pay any inheritance tax. And even his Duchy of Cornwall, which was like a full-time business, apparently made tens of millions of dollars of profit a year. Didn't have to pay any corporation tax, didn't have to keep any accounts either. So with that rant, let's look at the markets this morning. It's 8:36 a.m. London time. We've got spot gold at 1688. So yeah, we've dropped below 1700. More reason to keep accumulating it if they're giving us the opportunity to buy it cheaper, even though the premiums are higher. Do you really want to buy index-linked bonds? They could change the rules again, and they will definitely change the way they calculate CPIH in the next few years. You can bet on that. They changed the way they calculate CPI back in May to make it look less. So they're going to screw savers and pensioners, I think, of even more than 90 billion to 100 billion. It's going to be trillions that they're going to steal from you. And also with the inflation, of course. So yeah, the high's been 1698 and the low 1685. Silver is down 1% at 1941. Low has been 32 and the high 68. To the stock market, the Dow futures is up 50 points. NASDAQ is up 12 and the S&P up 6. FTSE 100 index is up 33. Eurostoxx 50 is up 9. To the currencies, sterling is down slightly at 115.30. The euro is down slightly as well at 99.73. Dollar is up 0.25% versus the yen at 143.50. The dollar is unchanged versus the Swiss franc at 96.22. And the dollar is unchanged versus the yuan at 697.66. Dollar is at 59.80 versus the ruble. So again, steady around that 60 level. Aussie dollar is up 0.1%, 67.56. The dollar is unchanged versus the Canadian dollar, 131.60. And the Kiwi dollar is up slightly, just above 60. To the general commodities, we got WTI crude up 0.25% at 88.30. Brent crude is up 0.1 at 93.64. High-grade copper is up 0.5% at 350.340. U.S. nat gas is down 1.5% at 9.05. It's up from when I spoke yesterday, but down on the close from yesterday. The Dutch TTF natural gas futures is up 7.5%, and it's back above 200 with a vengeance. It's trading at 230. And we're going to finish off with the bond market. Let's look at the UK debt market, the gilts. The 2-year yield is unchanged at 3.11. The 10-year yield is up 5 basis points at 3.18. And to the US Treasury market, the 2-year yield is up 5 basis points at 3.83 now. And the 10-year is at 3.44. Up 3 basis points. So the curve has inverted quite a bit more. And some people are looking at the 3-month to the 10-year. That hasn't inverted yet, but it's close to. So if you enjoyed this video, make sure you hit that like button. Make sure you share it far and wide. And if you watch my videos regularly but haven't subscribed, make sure you do. And also hit that little notification bell to be notified of all my new videos. And yes, with that, I wish you all a great rest of the day. Take care. Bye.